It's classified as a life and chassis.
Chassis?
Yes. So, let's go back to the 401k. Let's go back to the IUL. Let's mirror these two. I've got $100,000. I put $100,000 in the 401k. I put $100,000 in the IUL at the same time. They're both growing pretty much at the same rate because they're both, the 401k is actually in the market. My IUL is mirroring the market. Okay? So they're growing at 8% clip. If the 401k, if the market takes a loss, sir, I lose percent of my money. IUL, I lose none of my money. They both grow tax deferred. Now, I'm 64. I turned 65. Now I want my money. On the 401k, I have to wait till I'm 59 and a half to get my money. If I get it any earlier than that, there's a 10% penalty. And I have to take it at age 70 and a half. I have to. I have no choice. And the reason why they make you do that, ladies and gentlemen, Uncle Sam wants his money. He wants his money. As I'm taking distributions on the 401k, I'm paying taxes. Now let me give everybody a scoop here. Your taxes are going up. I want you to know that.
Yeah.
Joe Biden had no choice but to raise taxes. He got no choice. I'm telling you, don't blame him. It's the beast. The beast has to be fed. It needs money. So your taxes are going to go up. So originally your taxes may have been at 30%. They're going to go higher. Now I'm speculating. I'm not a tax expert. I'm not an attorney. But don't be shocked to see 40, 50%, 60% taxes. Because he has to feed the beast. The money's got to come from somewhere. So consequently, when I'm retired now and I'm taking this money out, I'm paying taxes on it, on the 401k. So my $100,000 diminished. So if I'm paying 30% taxes, I'm losing $30,000. 40% taxes, I'm losing $40,000. I only got $60,000, and it gets smaller and smaller. Now, the other thing that happens to you, normally, I was talking to Daniel last time we was here, and Daniel mentioned, he's got this beautiful home. He said he wants his children to take over this home. He wants to downsize, which most people do. Well, with that downsizing, also minimizes his tax deductions. So now he's paying ordinary taxes on that money, and he has less deductions. So that money that was meant for him to live off of is constantly shrinking under the 401k. Let's go to the IUL, Index Universal Life. That same $100,000, the same money. All right? I put it in. I've already paid taxes, which is called a cost basis. It grows tax deferred. And let's say it goes up to $200,000. Now I want distributions. When I originally set up the IUL, I sat down with Daniel and said, Daniel, how do you want to see this money? What's it for? So it's imperative that I set it up correctly. So Daniel, he may say to me, Derek, at 65, I want to start receiving income. So I can set it up at 65, the principal stays the same, but he gets X amount of dollars per year based upon the growth factor.
It has to be per year, can't be monthly, can't be
monthly, yearly,
quarterly,
okay. Whatever you want.
Okay.
You'll do whatever you want. But here's the blessing part of it. It comes out tax-free because of those codes 7702 or 77E. Because it's not an investment. So the money that you get does not trigger a taxable event. So now you get all your money. Now, let's say you died. Daniel, he got one year, he passed away. That $100,000, if it grew to $200,000, now his death benefit is at $400,000. So his beneficiary is going to get a life insurance policy based upon the death benefit and the cash value. You never lose both of them. You keep both of them the same. So I'm maximizing the opportunity in terms of cash in. It's just fill up the bucket. So the more money I put into this bucket, the more money I can get. So if Daniel doesn't, if he wants the money, he can get it. If he doesn't want the money, he doesn't have to get it. If he wants to leave it for his children, leave it children, he can do all that. But it all comes out tax-free. It's all tax deferred. And he controls the bucket the way he wants to control the bucket. The other way, you have no control. The government is controlling what you do and what you don't do. So I implore everybody here, if you got money in a money market fund, you got money in a retirement account, 401k, you just have money sitting in the bank, move it. Move it. Now, the company I do business with the most is Nationwide Insurance. They've been around 125 years. Every Moody to every company that rates them, they have the highest rating whatsoever. They're not going anywhere. Whether you know this or not, banks. Does anybody bank at Wells Fargo? Wells Fargo takes your money, and puts it into IULs. They pay you 0.0, what is it, 0.04 something percent. And they make it 8% of the same $100 you gave them. That's what they put doing. Insurance companies back banks. I don't know if you knew that or not, but they do. So I've said a lot. Miles, did you want to add anything?
I mean, you touched on it really good. I'm still learning this product as well. I mean, it's a vehicle that's huge, you know, and a lot of people are just not educated on this type of material. You know, that's why when I looked at it and we sat down and talked about it, like I instantly went to my parents and said, this is exactly what we need. And I was able to sell my parents an IUL. And I have an IUL for myself. At 24 years of age, I'm paying over $250 a month. By the time I'm 65, I have over $1 million in that policy. That's something that I can do for my retirement and leave for my children when that time comes. And you know, one thing about this is Mr. Campbell always preaches on everybody, music to their ears is tax-free, tax-free, tax-free. Especially with, you know, the laws that's finna be in place with the coronavirus, with Biden. It's very important that you understand that, you know, that I'm able to touch my money at any time and it's tax-free, where the government, Uncle Sam, won't even get a piece of that. So, I mean, he touched bases on that pretty good. But, you know, if I have any questions, feel free to ask.
I'm going to take any questions.
How old is Universal? I've never heard of it. I'm not a big time investor. How long has that product been?
Let me make one correction. It's not an investment.
Okay.
You cannot lose your money. It's not, if I'm in the market. But when I put money in the market, I can lose it.
Okay.
In this product, you cannot lose your money.
Oh,
but how old is it? It's been around since 1940. Now, let me just say this. The things I'm talking to you about have just made changes in 2020. The pandemic has caused many changes. Some good, some bad, but mostly good. Now, I'm not diminishing people's deaths. That's a tragedy. But it's caused the financial world to turn upside down in some aspect, and this is one of them on the good side.
What's the difference in after-tax Roth, finding an after-tax Roth versus the power of this index universal?
Great question. The question is, what's the difference between a Roth, which is an IRA Roth, and this one? If you're going to buy an IRA, always buy a Roth. Because Roth, you can get your money. You can get your money when you need it. And the reason why you don't pay taxes on a Roth is because you've already paid the taxes going in. But here's the difference. I can only put a certain amount of money in a Roth. A year. I can only put, you literally can dump $1 million into this plan I'm talking about and watch it grow. $500,000, $50,000. You can dump as much as you want into it. There's a thing called Modified Endowment Contract. They call it a MEC. I don't know if you've heard of a MEC. And what that means is that Uncle Sam recognizes that millionaires have used this vehicle for years. They dump money into this vehicle and they get it out tax-free. Well, Uncle Sam said, okay, we gotta slow it down just a little bit, because there's a gentleman named Walt Disney that started Disneyland with this vehicle. He took the money out because his parents dumped the money in. But the point is this: as this thing grows, as you put more money into this thing, you can get it out whenever you want to. The Roth limits the amount you put into it, and you can get it out tax-free, but because it's limited, it doesn't grow as much. This IUL can grow.
What's the engine that drives the IUL?
The market.
The people's market, or
Dow
the
Jones Industrial Average, the NASDAQ, and the S&P. That's a great question, man. You asked a great question. He said, what's the engine that drives it? What the companies do is that they take 50% of your investment and they mirror the best market out there. They take 30%, put in the next best market, and 20% put in the last market. It's called asset allocation. You heard that term before? And what they do is that they're constantly looking at the markets. And so whatever one's driving the best, They mirror that, and that's where they put the bulk of your money in. And they allocate that thing.
I go see.
Exactly. They allocate that on a monthly basis.
Yeah,
You gotta understand something, guys. I don't want to get off course with it, but I'm gonna tell you this.
No, we got to deal with money, period.
Okay.
That's it.
Let me tell you how insurance companies actually make money. People think that I pay my premiums and I make money on that. They don't make money that way. Insurance companies have to have a reserve out there. And the reserve has to be in billions of dollars. Most insurance companies, I'm gonna use Nationwide example, they lose money on your premiums because the claims are much higher than the premiums. The way they make money, ladies and gentlemen, is that putting it into the market. Nationwide's got billions of dollars.